Market risk analysis. It is the possibility of an investor experiencing losses due to factors that affect the overall performance of the financial markets in which he or she is involved. Market risk is also called as systematic risk. The component of risk which can be reduced by diversification is non systematic risk. Sources of market risks includes recessions, political turmoil, exchange in interest rates, natural disasters and terrorist attacks. Market risk affects the performance of the entire market. It is difficult to hedge as diversification will not help. Market risk may involve changes to interest rates, exchange rates, geopolitical rates, or recessions. The possibility of loss to a bank caused by changes in market variables. Types of market risk. First one, liquidity risk. Second, interest rate risk. Third one, forex risk. Fourth one, equity price risk. And fifth one, commodity price risk. In that, first one is liquidity risk. It is the potential inability to meet the bank's liabilities on the due date. It arises due to inability to generate cash to cope up with decline in deposits or increase in assets. Mismatches in maturity pattern of assets and liabilities. Dimensions of liquidity risks are as follows: funding risk, time risk, and call risk. Second one, interest rate risk. It covers the volatility that may accompany interest rate fluctuations due to fundamental factors such as central bank announcements related to changes in monetary policy. This risk is most relevant to investments in fixed income securities such as bonds. Risk that value of assets and liabilities as also net interest income get affected due to movements in interest rates. Types of interest rate risks are as follows: gap risk, embedded option risk, reinvestment risk, and price risk. Third one is foreign exchange risk. It arises from the change in the price of one currency in relation to another. Investors or firms holding assets in another country are subject to currency risk. Types of forex risk are as follows: open or mismatch positions, price risk, credit risk, country risk, operating risk, and legal risk. Fourth one is equity price risk. It is the risk involved in the changing prices of stock investments. Changes in equity prices can result losses to the bank holding equity portfolio. Banks are not allowed to sell the securities without holding the same. And the last one is commodity price risk. This risk covers the changing prices of commodities such as crude oil and corn. Banks have very little exposure to commodities in their trading book. Price movement in commodities is more complex and volatile. And the next concept is measuring market risk. In this, first one is value at risk. It is a statistical risk management method that quantifies a stock or portfolio's potential loss as well as the probability of that potential loss occurring. Investors and analysts use value at risk method to measure market risk. Second one is beta. It is another relevant risk metric as it measures the volatility or market risk of a security or portfolio in comparison to the market as a whole. It is used in capital asset pricing model to calculate the expected return of an asset. And the third one is mean variance portfolio. It is a portfolio risk measure which is most widely used. This model assumes that the risk of a portfolio is defined by variance or standard deviation of the probability distribution of portfolio returns.